I'm Laurie Hooper, and I am the General Counsel and Chief Compliance Officer for Adams Diversified Equity Fund and for Adams Natural Resources Fund. We certainly have been through many market cycles. Adams Diversified Equity Fund was known as the Adams Express Company for 150 years, and our second fund, Adams Natural Resources Fund, was known as Petroleum and Resources Corporation for 85 years. We changed our names in 2015. Adams Diversified Equity became a closed-end fund in October of 1929, and Adams Natural Resources had its IPO in January of 1929, so just before the market crash. So not a very propitious time for a fund to start, but we're still hanging in there, and we've seen about as many different cycles as the market can throw at you. And we think that part of our longevity can be explained by the fact that we are a closed-end fund. And there are several factors to the closed-end fund. The first feature of the closed-end fund structure is that we have a fixed capital base. We are not subject to inflows and outflows of assets based upon the shifting sands of investor sentiment. We're not required to sell stock to raise cash when markets are tanking, or to find places to put money to work when markets are overheated. The portfolio managers can manage the portfolio the way they want. They can build it the way they want. They can set a time horizon and maintain that time horizon because of the fixed asset base that we have. Another feature is low costs. Because closed-end funds do not have ongoing costs associated with distributing, issuing, and redeeming shares, we're able to keep our expenses lower. The closed-end funds have lower expense ratios than the average mutual fund does. And we all know how important expenses are and fees are to maximizing shareholders' returns. The third item is that closed-end funds trade on an exchange. And the ability to trade the stock on the exchange adds a lot of flexibility to investors. You can have intraday trading, real-time pricing. You know what you paid for your shares or sold your shares for. You don't have to wait for the end of the day pricing like you do in a mutual fund. And that can be particularly harrowing in a time when markets are plummeting like we've experienced not too long ago. Because they are traded on an exchange, you can do with them the same thing you can do with any other stock that you own. You can set limit orders, you can put in stop orders, you can even short the shares of a closed-end fund. The fourth feature is the discount. Closed-end funds typically trade at a discount to their net asset value. And what the discount is it's the ratio between the net asset value of the portfolio held by the fund and the market price. In looking at the discount, a fund that's trading at a 15% discount means that you can buy $1's worth of assets for 85 cents, but you still get the full investment power of that dollar. You're going to get the return that that dollar earns in the market, although you did not pay the full price for it because of the discount. And especially in times of volatile markets, what's important about the discount is that it can be looked at as a shock absorber. When there's market turbulence and markets are dropping and net assets are dropping, what is actually happening is that the assets that you paid 85 cents for are starting to come down closer to what you paid for them. So that's providing a shock absorber to the impact of the market volatility. Also, what we've seen is that in times of market turbulence, the market price of closed-end funds generally holds up very well, so that you have the net assets coming down, but you have your market price holding up, and that's really able to absorb the shocks of market turbulence. Well, I think it's important to note at the outset that investing in an actively managed fund is not mutually exclusive of investing in passive or index funds. They are both attractive investment options, and savvy investors can use both in building a diversified portfolio. We see markets as volatile and complex, and can expect them to continue to be so for the foreseeable future. And that is a good environment for active management. And the reason why active management works well in that environment is there are a number of reasons. One is that active managers can do deep analytic research into the stocks within the universe of their investable universe. They can get to know the companies well, and they can find value among the companies that are out there. Another thing is the flexibility that active management provides. An active manager can choose to not be in a certain stock, can choose to be in a sector or not in a sector based upon his or her view of the of where things are headed, and is not bound solely to what's contained inside of an index. Another item, and this is a very important one, is that active management provides you the opportunity for outperformance. By definition, an index fund or passive strategy cannot outperform the index that it invests in, but an active management strategy can. As an example, in 2007, the beginning of the financial crisis, Adams Diversified Equity Fund was able to outperform the S&P 500 by 100 basis points. Even more telling, in 2008, which was the worst year that the markets have seen in decades, it was a down year. Almost everything was down. Adams Diversified Equity was down, but it was down 265 basis points less than the S&P 500. And it's good to be down less than the index in a down year. The fourth item is that active managers can apply a risk management strategy in building their portfolio. Passive managed funds, index funds, do not take risk into consideration. Risk is not a factor, whereas we believe that risk management in building a portfolio is a key part of every active manager's process, or at least it certainly should be. What do you look for then in investing in an active managed fund? There are several things. Number one, you look for a portfolio manager or portfolio management team that has a long track record of performance. Experience counts. Second, you want to look for a fund that is operated in a cost-effective manner. We know how important fees are to the maximizing an investor's returns. So you want to look for a fund with a low expense ratio. You want to look for, third, you want to look for a fund that has a clear investment strategy. Fourth, you want to look for a fund that uses strong risk management as part of their investment process. And in the case of closed-end funds, you want to look for a fund that's trading at an attractive discount. You put all of those together and you have a very compelling investment option that can provide significant value over the long term.